Hello everybody and welcome to the Rainey Review for December 2024. This slide shows the growth of $1 in various asset classes for the 3 months ended 31 December 2024. Something of a mixed bag this quarter with both negative and positive returns. The leader this quarter is unhedged international shares in Navy, where $1 invested 3 months ago would have grown to $1.13. In second place is global infrastructure in orange, where $1 invested 3 months ago would have grown to $1.10. Middle of that mix pack is a 50-50 mix of shares and property and cash and fixed interest, where $1 invested 3 months ago would have grown to $1.02. This slide shows the growth of $1 for those same asset classes now over the 12 months ended 31 December. The leader over 1 year is, again, unhedged international shares in Navy, where $1 invested a year ago would have grown to $1.34. In second place, also again, is global infrastructure in orange, where $1 invested a year ago would be $1.25. Middle of the pack is that 50-50 mix of shares and property and cash and fixed interest, which would have grown to $1.10. That's a good year. 1 year is not long enough. I always say we need to look at least 3 years' data. This slide shows the growth of $1 for those same asset classes now over 3 years. The leader over 3 years is, still, unhedged international shares in Navy, where $1 invested 3 years ago would have grown to $1.47. In second place, also still, is global infrastructure in orange, where $1 invested 3 years ago would have grown to $1.34. A very meritorious third in Australian gold is Australian shares, where $1 invested 3 years ago would have grown to $1.28. Then there's a large gap to emerging markets in red, which just pips the cash return in green before the rest. Top of the rest is that 50-50 mix of shares and property and cash and fixed interest, which would have grown to $1.09. While this is flat over 3 years, it illustrates diversification well. It may not be top, but it will also never be bottom. With apologies to Lionel Shriver, who wrote the very good but quite difficult to read We Need to Talk About Kevin, we need to talk about Donald. Donald Trump was named Times Person of the Year for the second time in 2024. With a gift for bombast and self-promotion, he's certainly noteworthy enough to be named Person of the Year. However, that doesn't make him unique. Since 1927, when Time magazine named their first Person of the Year, Charles Lindbergh, every sitting US president has been named Person of the Year at least once, bar 3. 8 US presidents have been named Person of the Year twice, including Trump. 1 US President of the Year has been named 3 times. That's Franklin Delano Roosevelt. Of course, he's also the only president to ever serve 3 terms and be elected for 4. US presidents of whichever party tend to claim credit for stock market performance when it's good and disclaim all liability when it's bad, like politicians everywhere. That smacks of a hypothesis, the notion that markets tend to do better under a Republican president than they do under a Democratic president. We can test that. Here is the total S&P 500 price change under Democratic presidents in blue and Republican presidents in red since 1953. The median annual return under a Democrat is 12.9% versus 9.9% under a Republican. What this implies is that party affiliation has no direct effect on the performance of the US share market. We have also been told about the impact control of all 3 offices of the legislative and executive branches might have on markets. That's testable as well. The data, this time with a little more evidence going all the way back to 1933, is good for all scenarios. Since 1933, a unified government where the presidency, House of Representatives and Senate are all controlled by the same party delivered very strong returns of 14.4% per annum. But that is not materially different from a split Congress, where the House of Representatives and Senate are controlled by different parties, which also delivered very good returns of 13.7% per annum. Do Donald and friends matter to markets? Well, maybe. But perspective here is important. The weakest of all three scenarios still delivered returns of 11.7% per annum. What is the best way to respond as an investor to Donald Trump? Ignore him. As always, we should look through the noise, of which there'll be plenty, and maintain a disciplined approach to investing. Over the long run, it doesn't matter to markets who the US president is. Thank you all for watching. I look forward to updating you in the next edition of the Rainey Review.